Hello and welcome to the first episode of the Stockout, a show about CPG companies, supply chains, and CPG companies' supply chains. I'm your host, Mike Baudendistel of FreightWaves. I'm an analyst and market expert here at FreightWaves, and I've recently taken to following the CPG industry more closely by writing a bi-weekly newsletter called the Stockout, where I go through the latest issues in the CPG industry as well as uh, you know, relevant transportation news items and try to put those two things together in an edition that will be helpful to those companies in the CPG industry as well as others with an interest in transportation, logistics, brokerage, et cetera. Today, what I'm planning to do is go through some of the latest news in the CPG industry, particularly those items that are relevant for supply chains, logistics, and transportation. And then I'll talk a little bit about some of the industry themes that have really stood out to me when I've gone through some of the companies' earnings reports and some of the industry trade rags. But before I do that, a word from our sponsor. Trust the experts at Echo Global Logistics for all your freight transportation and CPG shipping needs. Whether you are a Fortune 100 CPG company or a specialty food manufacturer, Echo has solutions to fit your needs. With their dedicated team, as well as Echo Ship, a self-service shipping portal allowing you to quote, book, ship, and track, Echo has you covered. Technology at your fingertips and experts by your side 24 hours a day, 7 days a week. To find out how Echo can simplify your transportation management, visit www.echo.com/CPG today. So thank you to Echo for sponsoring that. I was pumped when I heard that Echo was sponsoring it. Used to follow them at Stifel and actually visited their headquarters one time in downtown Chicago. It seemed like it was just about the most energetic transportation logistics company I had been to. It seemed like the average age was about 25 and people were having a good time in addition to working hard. So thank you to Echo. So on to the CPG content. So sort of one of the questions I get asked a lot by clients is why we have so many podcasts and shows. And the client asked, how could anyone have time to listen to all the content that we're putting out? And my response was, well, you can listen to it on drive to work. You can listen to it, at the gym. I think about 5 or 6 FreightWaves podcasts, go on my, device every day. And it's like, as long as you're working out for 3 hours a day, like you should be, then you have plenty of time to listen to all these podcasts, while you work out. But all kidding aside, really the reason why we're doing this one and why we do so many is to make them, targeted to the specific audience as possible. And, this one is going to be one of the more targeted podcasts. I think some of the others are a little bit broader, like some of the ones that I was on earlier this week. But with CPG specifically, CPG, consumer packaged goods. For those of you who found your way here from another FreightWaves podcast, those are food, beverages, cosmetics, cleaning, and other household products. They're things that are replenished that we buy over and over again. A couple times every week. Most people buy these products. They're heavy. Think of beverages. They're difficult to miniaturize. It's hard to download a hamburger or a steak. And a lot of these are manufactured domestically. And when you manufacture things domestically, a lot of times they have multiple points of handling, multiple different stages within a supply chain. So those things make the industry more freight intensive than it would otherwise be. Another interesting stat is CPG represents about 1/5 of all freight moves, and a large portion of the delivered cost of CPG is represented by its freight and logistics costs because these are big, bulky, heavy things that gets purchased again and again. It's sort of the antithesis of a computer, or really the antithesis of something that you might download, which is getting to be distribution for a lot of products these days. And really, CPG has become more has been more in the limelight, I think, in the last year. It's been under more scrutiny because COVID in the last year. We had these stockouts of things like toilet paper. We had grocery store shelves that were cleared out, and then all of a sudden, people who never, sort of took these products for granted, all of a sudden are, wondering, where are they going to get some of these things, and had to make decisions about, purchasing, items they don't typically purchase. It gave really a lot of the CPG companies a way to attract consumers who may not be accustomed to, doing a lot of cooking, doing a lot of shopping, a lot of those difficult to reach millennials. All of a sudden, it gave them sort of a captive audience to attract a lot of those customers, for the first time. And a lot of CPG companies have done really well with that. I mean, I think one of the big trends in the last year have been the national brands. A lot of these household names have actually gained, market share from the private brands, the private labels. Private labels are things you think of like the Kirkland brand at Costco, or the Up and Up brand at Target. Those have been very successful. But in the past year, I think, maybe with, people not spending money, going out, they felt a little bit more comfortable buying the little bit more expensive brand names, or just as a way to comfort themselves, shifted back to some of those national brands. So those are, so a lot of the companies that are, are included in the national brands, as well as some of the ones that actually supply to the private labels. Those are the companies that I'm hoping to make this show relevant for. And I hope you find something, something helpful, in some of this data. And I think the advantage that we have at FreightWaves is that, I can leverage a lot of the expertise of my colleagues here at FreightWaves, who have been involved in transportation, pricing, logistics, brokerage, et cetera, for a long period of time. A lot of those, people have actually moved this freight throughout their career. I was, just an analyst following numbers, but a lot of my colleagues actually have experience in the field, having moved these loads for, the big CPG companies like Nestle and Pepsi. And then the other thing that I think is going to be a differentiator with this podcast is going to be leveraging the data that we have, contained in Sonar, that we, purchase from suppliers. And what you're looking at here on the screen is a sample of, and this is maybe the best example I can come up with, for as to why CPG companies had a difficult time in the last year with freight costs. And companies that have been reporting their earnings recently have been talking about inflation, and I think it's going to be a theme going forward. But what we're seeing on the chart here is the outbound tender rejection index for dry van in blue and for reefer in green. And you typically think of a market where there's a lot of spot activity when those rates go above, say, 7-8%. So there's always, some, rejections where the carriers say, we don't have capacity to handle that load, either because we're not in a certain market, or because there's the price isn't right, or et cetera. But you can see how it went from, early 2020, the market pretty well behaved, sort of mid a single digit tender rejection rate. There was enough capacity, and then all of a sudden, last March, the capacity for transportation was extremely short. Some of that was because some people decided to stay home and not drive a truck, and you're not paying me enough to drive a truck when there's this pandemic. But for the most part, it was, in March, people scrambled to get their groceries, to fill their freezers, to prepare for this lockdown. And a pretty consistent pattern has been, the reefer market has been tighter than the van market. And there's been a lot of reasons for that. Part of that's because there's been greater demand for frozen foods, and, things like frozen meats, which have done extremely well over the last year. But also, I think a lot of the capacity that has come into the marketplace over the past 6 months. And I was just doing another webinar on this for the Passport Research Group, and we took a hard look at which segments have capacity coming into the marketplace. And what we found was that there was a lot of that capacity was coming from small carriers. A lot of it was coming from company drivers who decided, because the transportation markets were so tight over the past several months, that they decided to go out on their own as an owner operator, and that has done things like push up the prices for used trucks. This next slide is another thing that the CPG companies have had to deal with. And so not only are more of the tendered loads, sort of the CPG companies that are requesting loads to be moved, not only are more of those being rejected and falling through to the spot market, as you might expect, the spot rates to move those loads is very elevated relative to where it was. You think about this time last year and the loads that were falling the spot market, they could still be moved on the spot market, for about $2 a mile, including fuel surcharge. So, it was getting tighter, but it wasn't yet a disaster. And lately, it's been a little bit more of a disaster, where the average rate nationwide is $3.18 for a dry van load. It's $3.66 for a reefer load. That's according to truckstop.com. Those are spot rates. So those are loads that mostly started out as contract loads, but the carriers rejected the tenders, and so they fell to the spot rates, and so a lot of the carriers have taken advantage of that by moving loads at very high rates, and some of the ones that participate less in the spot market would be someone like Martin Transportation, who sort of recently followed their earnings report, and the way that they approach the market. Martin is one of the biggest reefer carriers. It's the only reefer carrier that's publicly traded. But their response to the market was, let's upgrade our freight selection, and let's only accept the freight that fits well into the network, that's highly rated, that is not going to have a lot of downtime for that expensive equipment, which is the trailer in the case of reefer, and the scarce resource, which is the driver. So they've done a nice job of taking advantage of this market to improve their margins. Of course, for the CPG company, this has been very challenging with rates that are rising, and that's been a pretty consistent theme that I'm going to get into when I talk about what's happening lately in the CPG space. So that's a little bit of an intro, and now I'm going to go into the news. And what I do with the newsletter is, I look for stories that aren't just sort of the stories that are the biggest headlines for CPG, although I will talk about some of those, but also the ones that are related specifically to supply chains. So I'm going to focus a little bit less on things like M&A or a company getting acquired by private equity. You do see that a lot. You see a lot of companies that will sell brands, buy brands. A lot of the companies in the CPG space are looking to add brands that have sort of a quote unquote halo effect, where this is a healthy brand. They're trying to get rid of brands that aren't healthy. They're trying to get brands that are in growing niches, like things like plant-based foods and pet foods is actually been the fastest growing uh, subsegment of the food and beverage industry lately, with more people adopting pets during the pandemic. But I've got 7 items on the list of news stories. The first one came out a couple day or two ago. The ketchup shortage is the latest shortage of CPG. So we started out last year with at this time there were toilet paper shortages and shortages of meat and those things, and milk was going bad, and we've almost seems like we've come full circle, where people have adapted to the takeout, and people are door dashing and being door dashed too. And this has left a shortage of those single serving packets of ketchup. And then the people who are going to restaurants, they are not so much stocking the shared ketchup jars that a table would use, or would go from one table to the next. They're sort of sticking with those packets, and now the packets are in short supply. And actually, the prices of those packets are up 13% in the last year or so. In the packet usage is up about 15%, and that's caused a shortage. Kraft Heinz is of course the biggest manufacturer of ketchup. They have about a 70% share, and they've been increasing manufacturing. Their manufacturing lines. They've added about 3 different lines. They've increased their total production about 25%, and then shifted some of the existing resources, to the single serving packets. And so it's kind of a theme that's taken place throughout the CPG space over the past year. You think back a year ago, and at the same time, it was difficult to find a lot of places, beer that was in cans or bottles, but at the same time, stadiums were dumping kegs of beer. So it was just almost the packaging that was wrong, things spoiling and things in short supply, at the same time. I think it'll be interesting to see how that all unwinds when things start, opening up again. And then another theme is that a lot of the CPG companies are struggling with how much manufacturing capacity to add, because a lot of these products, most of these products are manufactured domestically, and that's been sort of the big constraint. It hasn't been so much the inputs like it has for the auto industry, where they just haven't had the components to assemble a vehicle. In the CPG space, there's been a shortage of manufacturing capacity, and so the companies have had to make difficult decisions about how much manufacturing capacity to add back. So that first story I think is interesting with the ketchup shortage. I guess another thing I didn't know from the Wall Street Journal article where they talked about that was that Kraft Heinz uses a very specific blend of strain of tomatoes. That's a hybrid of a couple different types of tomatoes that are grown in the Central California, and that's sort of how they get the taste to be what it is. And it seems like that's been just a really big differentiator of why that particular type of ketchup tastes as good as it does. The next item I have on news is Conagra. So Conagra is big CPG brand that has a lot of household names, Hunt's, as well as Orville Redenbacher, a number of others. They reported earnings yesterday, and the thing that stood out to me in their earnings report is inflation. And in recent quarters, they've talked about their cost inflation increasing about 2.5% from the previous year. This past quarter, they just reported yesterday 3.9%. So that's a big increase going from 2.5 to 3.9 for an industry. Food and beverage, they don't take a lot of sharp price increases. A lot of the CPG companies will talk about price increases, increasing less than 1%, 70, 80 basis points a year. And so that creates an issue where they have to do something. They have to find a way to improve efficiencies in some other way, or take pricing in order to not to preserve their margins. And then Conagra went into a little bit more detail. They said that materials up 3%, 3% inflation in materials, 4% inflation in manufacturing, and then transportation and logistics costs. Those are up 8% from where they were a year ago, and that's been the big delta, the big change in the guidance and expectations there with inflation. And then included in that was they spent an incremental $15 million in transportation and logistics expenses to increase its supply of products, to the stores, so to get those, on the shelves, quickly. And I think that's going to be a big theme as I watch the CPG space over the next year. Is some companies I think are going to be able to mitigate that inflation, better than others. And I read one analyst, was talking about how because inflation is so widespread, that it's going to force prices to rise. If it was just in a certain area, then some companies might have the luxury to sort of keep prices where they are. But the private label is probably likely to raise their prices sooner, and then maybe that gives the national brands, companies like Conagra, et cetera, a chance to raise prices, to have a little bit of a spread there between the private label and their prices. But certainly, I think the Conagra, that item number two on the news, highlights the increase in inflation. I think that's going to be a big theme as the companies report earnings in April. Third item I have is meat may be the most vulnerable segment to consumers getting their old lives back and returning to restaurants. And sort of the reason for that, there was a study that came out. Numerator, which is a data company I had not heard of before, maybe because I hadn't followed the industry as closely until now, but they rolled out what they call the grocery vulnerability index. And so what they did is they looked at all the different grocery categories, and they said, well, which ones are most vulnerable to a return, at least partially, to consumers' old habits, where they eat fewer meals at home. They go out to eat a little bit more like they used to, and they just decided that meat was the most vulnerable. It was about 50% more vulnerable than the typical grocery product, and the reason for that is meat is typically what people get when they go out. They go out for a nice steak or something, and it was something that people filled their freezers up with during the pandemic. The meat did a lot better than most grocery categories during the lockdown. Actually, in 2020, meat sales were up about 42%. I saw, so that exceeds what most consumer packaged goods increased. Most of the companies that have like a at home consumer packaged goods segment, they said that their at home was up sort of high single digits, and then the stuff that's for outside the home, that was mostly down like 30%. But meat did better than most, and so I think the idea is sort of what came up is likely to come down. The counterpoint to that would be that a lot of consumers plan to cook uh, in a way that is higher than they have been, before the pandemic. That a lot of consumers are getting sort of the hang of grilling steaks, and may continue to do that. I guess if you look at it, sort of the opposite side of the coin, sort of which CPG companies could really benefit from a return to consumers' old lifestyles. I think one area that stands out is milk. If you think about back a year, there was lots of milk that was just being dumped because it was spoiling, and a lot of milk is consumed in places like schools. The fourth item I have here is General Mills. The big CPG company that does think of them as cereal. They do a lot of other things. Is also they're reducing their reliance on third-party manufacturers. So a third-party manufacturer is a manufacturer that's not owned by the company. And what they did is they increased their reliance on third-party manufacturers when there was this surge in demand for their products, during the pandemic, and that capacity is much more expensive. It's associated with 10 to 15% lower gross margins for on revenue that's manufactured externally. And so the idea is that they manufacture the base volume, the cereal that moves every day, they manufacture, and then the surge they use an external source, and that they can clearly will get rid of that external source when demand starts to fall. But what's interesting is also an admission that okay, this elevated level of demand for things like things like breakfast foods is not going to stay that way for forever. The fifth item I have on the list was one that came out. I think the Wall Street Journal broke this last night. Was Procter and Gamble was collaborating with a Chinese company. I think it was a Chinese company that was affiliated with the government on a way to circumvent Apple's upcoming privacy restrictions. I'm not going to spend a lot of time on this. It's not really related to transportation or logistics, but I didn't think it was interesting that how much data they have captured. Procter and Gamble has digital portfolios on a whopping 1.5 billion consumers worldwide. I imagine that's everyone who is listening to this, and then it sort of gets back to one of the more interesting stats I think I've read is virtually everyone on the planet uses a P&G product in some manner or every day. It's kind of this maybe the most ubiquitous company in the world, but it'll be interesting to see if there's actually any pushback on some of the ways that they're capturing data. I mean, they would probably say, well, everyone captures lots of data on their customers, and P&G, because they deal in personal care items. It's very specific to the person's gender, age, et cetera. So they really want to know exactly who they're targeting, but they're trying to have essentially a digital footprint that if you use a bunch of different devices, that it can all be sort of tied back to one person, albeit anonymously, so they can have advertising that's very specific to a particular consumer. Seventh item or sixth item on the list is McCormick. I think we all know their spices. This company has brought back about half of the suspended items. It too had was short on manufacturing capacity, and it brought back about half of the items. So some of the items that they had to that they stocked out of were herbs, spices, recipe mix, things that people clamored to when were sheltering at home and wanted to cook at home. They have made a lot of progress getting those items back on shelves, and have a little bit more to go. Seventh item is Utz. People in Baltimore know who Utz is. They bake salty snacks like very delicious chips. They're extending their distribution in South Florida, acquired the distribution rights to expand there, and are also doing more to convert direct store delivery routes to independent contractors. A little bit of a curious move, because the company had sort of like that this direct store delivery, because it allows them to interact more with the store level buyers, and it gives them a little bit more control. So some of the themes, and I'll touch on these, quickly. I have a couple minutes left. Is there's been a big shift in the industry to plant-based diets. I wrote a report that I was just talking about on What the Truck, talking about my experience and taste testing some of the products like the Impossible Burger, which has a pretty good it's pretty good mock-up of what an actual hamburger tastes like. But that's been a major theme. Lots of companies are rolling out products that are plant based, whereas they would have been animal based before. At the export, agriculture exports, I think is one that's really growing right now, because China is rebuilding its hog population, so lots of crops are being exported out, and really, pet food is a huge thing now with people adopting more pets. It's actually the fastest growing segment at Nestle, the world's largest food manufacturer. And then ESG is a huge focus, and I do have one chart on intermodal savings if we have time for that, which shows the intermodal contract savings, and it actually shows that companies that move goods via intermodal to the same three-digit zip that they would have using a van. You can see in blue there, save about 20% off their freight bill if they're using intermodal versus truckload. This is from data that we've compiled from a company involved in freight transactions. And then in orange, I'm sort of comparing that to outbound tender rejection index, which is what we think of as being a good indicator of the relative tightness of the market. And so the idea is, as the freight market tightens, companies can save a little bit more by moving via intermodal. So hope you can. That's really what I wanted to go over today. And next week, L'Oreal, the big cosmetics giant, will report earnings, and so plan to go over any takeaways from that earnings report, as well as anything else that comes across the transom. Please sign up for my newsletter at www.freightwaves.com/the stockout, and you can sign up for twice weekly newsletters. But with that, hope everyone has a great weekend, and feel free to reach out with any topics that you'd like me to cover.